Am I audible? Shazia, can you hear us? Okay, am I audible? I'm asking all the guys whether you're listening to me or not.
Yes, we can hear you. We can hear you, but we are not sure whether SCCP meeting room can hear us or not. Yeah, but we can hear you.
So can people from SCCP room tell us whether they're able to hear us or not?
Mustafa Saab.
Walaikum salam. Yes, now we can hear you. Imran Sahab, I think we can, they can hear us now and we can hear them.
Okay, Assalamu alaikum everyone. I welcome you all in this session. And this session is about two important standards issued by AAOIFI, FAS 42 and FAS 43. FAS 42 aims to prescribe...
Unfortunately, हमें आप लोगों की आवाज नहीं आ रही, so we will reconnect.
Okay, please.
Okay, please reconnect. We are waiting. Okay.
Ji, Assalamualaikum. Ji, sir, we can hear you now. So the issue is resolved.
Okay, we can hear you also.
Thank you.
Okay, Assalamu alaikum everyone. I welcome you all in this session, and this session is about two important standards issued by AAOIFI, FAS 42 and FAS 43. FAS 42, presentation and disclosures in the financial statements of Takaful institutions, aims to prescribe and improve the presentation and disclosure requirements for the financial statements of Takaful institutions in line with the global best practices and align the same with the new AAOIFI framework and the newer standards, and to reflect the business model of the Takaful institutions in a fair and more understandable manner. The standard shall be applicable to all Takaful institutions, regardless of the legal form or size, including Takaful window operations. The FAS 43 standard, sets out the principles for a recognition and measurement of Takaful arrangements. The standard shall be applicable to Takaful institutions and their managed participants, Takaful fund and managed participant investment fund in respect of Takaful arrangements, Takaful arrangements, investment contracts with participants, with or without discretionary features and ancillary transactions. The purpose of this workshop is to shed light on these standards, as these standards are probably aligned with the requirements of IFRS 17. Now, may I request Mr. Naved Jamal to please give his opening remarks. Over to Mr. Naved.
Bismillahirrahmanirrahim. Assalamu alaikum, everyone. Can you hear me loud and clear?
Yes, we can hear you, sir.
Okay, let me start that by saying thank you for all of you to joining today. On behalf of Insurance Association of Pakistan, I also would like to welcome you all. And as mentioned, the purpose of the session. So as all of you are aware that currently we embarked a journey to implement IFRS 17 insurance contract. And we have already completed second phase of this implementation. And now looking to start the commencement of third phase, which is system design and methodology. And I'm sure that SECP and the working group of ICAP and IAP are planning to commence that work in coming few weeks. But before we start the third phase of IFRS 17, there are certain critical areas of operations which needs accounting and actuarial clarity and guidance, and some framework and methodology has to be agreed before we start the work on the third phase. And among those critical areas, one of the most critical areas is Takaful operation, because now if we talk about the non-life insurance side, Takaful has become the 10% of your overall business so far. It's a good progress in last 5 to 7 years, thanks to the window Takaful operations. And total insurance premium contribution have a very significant portion, like a 10%, as I mentioned, based on the 2022 figure coming from the operations. So what we do for the Takaful operations is very important. And in this discussion, we must face the issue is that as we understand that IFRS 17 implementation on Takaful operation, it's under discussion. And we have been informed that since the IFRS 17 is more explicitly explain accounting of insurance contracts, its compliance wants some Sharia compliance related issues which needs to be looked into more detail. I believe in this regard, various discussions were done at the IFRS 17 working group and other forums as well. And various options were also considered for accounting of Takaful operations. However, one of the very strong options which was discussed and considered, that use of Takaful standard, which we are going to learn today from our expert. And I also say these are the Islamic standards instead of IFRS 17 for Takaful operations. This is the option which we should discuss and debate and reach to a conclusion before any final decision be taking. So to understand and to explore this option of using FAS 42 and 43, which completely deals with Takaful operations, we have invited one of the experts on the subject, and the Secretary of Islamic Accounting, Auditing, Accounting Standards, Sharia Compliance, Mr. Umar Mustafa Ansari, to provide the overall view and the treatment suggested by FAS 42 and 43 for the Takaful operation, irrespective it's a window operation or it's a full-time operator. And I believe it would be very useful to understand how FAS 42 and 43 provide alternative to IFRS 17. Also, it would be useful if Mr. Ansari can highlight that IFRS 17 has already become applicable in some of the territories and some will join soon. So in that situation, what is happening in those areas or those countries or those territories where IFRS 17 is implemented or is about to be become applicable soon? For insurance industry, since it's the most important stakeholder of this implementation exercise, so all my colleagues who are joined so far, I must request you that we must try to gain some answers from today's presentation and keep on discussing crucial points. The consensus can be achieved. Okay, I will not take more time. However, on behalf of IAP, I once again like to thank Mr. Ansari for making this useful and one of the crucial presentation today. As I mentioned, Mr. Ansari is currently Secretary General of Accounting Standard Organization for Islamic Financial Institutions. I am sure when he'll start speaking, he will give you more elaborated introduction. I will take the opportunity to also thank Mr. Umar Murshid, who is continuously providing guidance and support of this project from his vast experience and expertise. And I also would like to acknowledge the contribution of concerned SECP personnel, just to name it, Mr. Wasim Khan, Ms. Shazia, Gibran, and other also well. They are, as I see it, they are working with utmost dedication so the IFRS implementation can become possible for the Pakistan. In the end, I also like to thank our insurance colleague who, despite their busy schedule, do find time to attend these sessions and always provide their valuable input. So that's from IAP side. Now I request Mr. Ansari to start the presentation. Thank you very much.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuhu. And thank you very much, Naveed Saab, for the initial remarks and your kind introduction. The organization's introduction will come in my presentation. Very brief introduction about myself. I'm myself a chartered accountant. I was with EY before joining AOFI, earlier as Deputy Secretary General. Now I'm working as Secretary General for Accounting and Auditing Organization for Islamic Financial Institutions, short name as AOFI. This insurance related function of ICAP, I have been part of it maybe for 15 years or so, and also the Islamic Finance Accounting Standard Committee in Pakistan by ICAP. So I have been part of these things, and actually the earlier draft regulations and draft regulations for the final regulation 2012 for Takaful and the accounting regulations, I was part of all those committees. So actually that whole experience that we gained actually from Pakistan has actually helped us in working here at AOFI. So without further taking your time on this introduction, I can see a lot of good friends here. So a lot of you already know me. Before going to that, presentation, I would like to submit only two things very quickly. That about the discussion that we are having. What is the status of that? So I believe that there are 2-3 areas where things are actually going on at the same time. One is the ICAP's committee itself that has been working on implementation of IFRS 17 on request of SECP. SECP's work is going on, and ICAP's committee's work is going on to support the SECP for that. As of now, the decision with regard to adoption of whether IFRS 17 for Takaful or whether these standards for Takaful is the main discussion point, and for which it is very important that all of us as a collective, representatives of the industry have a look at these standards and try to find out as to how these are more suitable for the Takaful industry to have a faithful representation, and what will be the challenges if we go with this, and what will be the differences with IFRS 17 that we need to address, and what differences with IFRS 17 may be justified or may not be justified. So this is one part of it. The second part that I would like to mention is that on the other hand, we have a decision of the Federal Sharia Court more recently, which has actually not addressed specifically the insurance industry, but it has addressed mainly the Islamic finance industry and prohibiting the interest in it, all its forms. Obviously, the implementation of that judgment in details with regard to the insurance sector is not that much clear, but this is understood that with the advancement of Islamic finance, on which the current government, the regulators have given their own, are working on their own plans and have given their own positive, comments on that they want to move in the direction in line with the Federal Sharia Court judgment. So even if within the 5 years time frame, full conversion might not be possible, but Pakistan is right now in a unique situation where we expect a significant, or as per judgment of the Supreme Court, Federal Sharia Court, 100% conversion of the conventional finance sector into Islamic finance. And obviously, when we go for those details, obviously the conversion element and the effects of conversion of the banking and other financial services sector on the insurance sector will come. So even if the judgment may not address some of the aspects related to insurance directly, but the issue will still be there that the institutions, the financial institutions who are on the other hand, when they convert, obviously the related facilities and things and their insurance and the bank assurance business and so many other activities, they all have to be converted into Islamic part anyway. So we should not only be considering the element of 10% today. Alhamdulillah, that 10% is already a good thing achieved without any that sort of judgment or any comprehensive conversion exercise. But we should start thinking that maybe for in the times to come, the percentage of that we are trying to think of right now as 10% and increasing to maybe 15-18%, might be even 50, 60 or 80%. Again, I'm not concluding on all these things. I'm just saying that while we address these things, we should not be just considering Takaful to be a very small segment of the market, but rather we should also consider what Takaful holds for future, inshallah. So this is the first part. Today's presentation that I have is quite detailed because it touches upon some of the concepts. Yeah. Hello. I think there is somebody. Okay. So the presentation that I have is quite long, so I'll have to skip a lot of areas. We have some conceptual parts, a little bit introduction of AAOIFI, and then we have some discussion in detail for FAS 42, 43, the requirements, some of the key differences with IFRS 17. So maybe the time might not be sufficient enough, but I'll try to cover. And with me, we have Brother Harun Tabriz, who is also a fellow chartered accountant and member of Sharia Committee of SBP from IBA. He is actually going to he has been instrumental part in developing this one, and I'm going to actually miss out Umar Murshid Saab, who is chairman of the ICAP's committee, and also he was instrumental in developing this standard itself at AAOIFI as vice chairman of the working group and the main contribution provider for this one on the technical side. So, in a nutshell, the presentation we will be sharing with you, and obviously standards will be available are available already on AAOIFI's website. But in a nutshell, maybe I might be a bit quick on these things today. As a decision with regard to implementation is taken, I think more detailed sessions like this will be needed. So with that, with your permission, I'll share my screen and will take you through the presentation. I hope my screen is visible to all of you. The starting point, I don't want to take too much time for you in the preamble and the initial discussions, but one thing I believe, and we all need to understand, that Takaful is actually needed because Islam as a complete deen, as a complete system of life, provides its own system of life in all aspects of life, which include the economic, social, political systems. These are integrated together with as well, because you cannot just completely eliminate Islam's social system from the financial and economic system. They have to be integrated and supporting each other. And that's why we always talk about Islamic finance to be integrated with social finance. But right now, what we want to address here, without going into any detail, is that the guidance is provided by our deen, Islam, in different forms. The initial starting points for the accounting related requirements are coming from some of the holy verses of the Holy Quran, and then the guidance that is provided in Hadith and Sunnah, and interpreted by fuqaha in form of fiqh. But some of the most important elements are there. And first, I would like to just mention one of the teachings that is about, you believe when you transact a debt payable at a specified time, put it in writing and let a scribe write it between you with fairness. A scribe should not refuse to write as Allah has educated him. He therefore should write. The one who owes something should get it written, but he must fear Allah his Lord, and he should not omit anything from that. And do not curtail the measure and weight. You need to reflect the rights and responsibilities in the fair manner. Give full measure and do not be among who bring loss to others. Weigh with an even balance and do not make short of their things. And woe to the curtailers when they measure something to receive from people, take it full, and when they measure or weigh something and give to them, give less than due. Do not eat up each other's property by false means, and do not eat up their orphans' property along with your own. And Allah commands you to deliver trust to those entitled to them, and ask the people of zikr, wasalu ahla zikr, that who are experts in the area, approach them and ask them what is the right way of doing things. Why I'm referring to it without taking more time, I would just like to say that some people have a misconception that accounting is, for sure, people feel accounting is secular or neutral. But the point is, accounting is reflection of the business facts. And if the business is being done in line with Sharia, then you need to always keep in mind that you have to follow the divine guidance through which the core concept of that business is coming. We'll touch upon some of the aspects going forward. Here, I would like to touch upon some of very important points that we need to understand, because all of us sitting here might not be experts in Islamic finance. So I don't want to go in all the details, but the core principles of Islamic finance that apply to the banking, finance, and Takaful, some of them are very, very relevant to be understood before we go for understanding how we need to do the accounting. So the core differences of the conventional and Islamic finance, including Takaful, you will find that prohibition of riba is the first one, and riba takes different forms in case of Takaful. Riba, it is an indirect form, it is in an indirect form. There are different type of transaction structures, including the exchange of money transactions, which actually happens in case of exchange-based insurance transaction, which creates a form of riba. Similarly, the investments of insurance companies are often done in impermissible and non-Sharia compliant activities, including interest-bearing transactions. Prohibition of gharar and mesar are other two more important elements which directly exist in a conventional insurance transaction, which are prohibited by Sharia. Again, today's discussion is not on all those things with regard to the justification, etc. Right now, we are just going to try to identify why this Takaful as a separate business exists. It exists because there is a need of it, considering that the conventional insurance is impermissible. And these are the three main elements: the prohibition of riba, gharar, and misr and qimar, that if they exist in exchange transactions, these are the ones that actually create impermissibility. And Takaful is a effort to find a solution to these prohibitions. Equitable distribution of risk and reward is the next condition. Time value of economic resources versus time value of money is the other important element. Integration of moral and ethical values is another important element. These are the main differences that distinguish Islamic finance from conventional finance and Takaful from conventional insurance. And I would like to disagree with some of my friends who believe that Takaful is just a product. I would just say one sentence here, that Nauzubillah, you cannot make fool of Allah subhanahu wa ta'ala by just making a bunch of papers which is different from the bunch of paper that you can call conventional insurance. It's not only about having a different bunch of paper or a different contract, it's also about having in essence, a really different business model that reflects the true nature of that business in line with Sharia principles and rules, avoiding the prohibitions that are there from the conventional side. And this approach of having Takaful only as a product, only has a different bunch of paper, I believe is something that can, sorry to say, make fool of people for some time, but can never make fool of Allah subhanahu wa ta'ala, and can never make fool of people even for a longer time, I can tell you. Again, we can, if time permits, we can have some questions on these issues. So then there are some benefits of standardization, etc. I would like to touch upon them because if you develop the local standard versus go for global standardization, you have so many different benefits that are coming. So I do not want to go in detail, but standardization in a nutshell creates harmony, make sure that you follow the best practices, and in turn it actually helps you save money and have better utilization of resources, because reinventing the wheel is not there. Better resources and more educated resources and more experienced resources, because of having the same product, working under same principles and the same standards. Actually, this all helps you in eventual cost saving, as well as in having the harmony which leads to the long-term growth of the industry. So again, as of now, we have to focus more on the discussions, technical discussions. So we will not be going on that. But what I want to focus now on this slide is something important. about need for Islamic finance accounting to be different from the conventional accounting. So there are arguments for that on both ends. Some people believe that the conventional standards can address Islamic finance also, because the accounting is like, you know, is neutral or secular. Some people feel that accounting is because in dealings everything is permissible as per Sharia. So some people feel that actually it doesn't matter what accounting standards you follow. Accounting is neutral, accounting is secular, means that it doesn't have anything to do with any religion. And accounting is post facto, so there is no impact. This is an argument that is actually brought in by some of the scholars themselves as well, who do not go in those details, that even they believe, okay, if you did the right transaction, the contract is permissible, you followed the right sequence, then accounting is a post facto thing, you can live without it. There are, like, you know, arguments on that, and this is one of the arguments. Maybe the argument number 1 and argument number 4 are the arguments which are brought in by some of the scholars in some countries as well. So we always have an argument that in some countries, you know, IFRS is applied even to Islamic finance transactions, while some scholars are accepting it. So the argument is that they actually accept for these arguments which are appearing as no, that Islamic finance separate accounting is not needed. But when we come to the counter arguments, like, you know, we have a few more elements that we need to consider. So the first one is to deal with the specific information needs. Accounting is the language of business which addresses the specific information needs of the stakeholders. And if the set of stakeholders is different, and the set of stakeholders have different information needs, and particularly one set of stakeholders, we call them the Sharia conscious users of financial statements, who have their own need for the specific information needs that they have. So from that perspective, these guys actually like, you know, need to know that it's not only the issue of earning something, it's also about having earned it on halal way or not, and to know the rights and responsibilities and obligations of each of the party in the right manner. Then it is about the real, true, and fair view, that the new IFRS framework also referred to it as faithful representation. So that is the next element. The third part, which is very important, is about the transaction trail of the transaction, whether the transaction that has happened has been following the right transaction trail, right timing of recognition, right timing of recognition of each expense and each income, and each right and obligation has been defined and accounted for at the right time. This whole is part of the transaction trail, which is very important to make sure that the Sharia compliance of the transaction and the sanctity of transaction is actually maintained. Then we have the risk profiles of the transactions and balances. So the element of having a different risk profile from the conventional counterpart transactions is very important. Like a Muraba receivable may have a risk profile which is different from a conventional loan transaction. Again, I do not want to go in all these details, but the point is that what you show as payable and what you show as receivable and what you show as payable to a party and to another receivable from another party may carry different risk profiles in different eventualities. And those different eventualities may impact those balances to be accounted for. So for example, something is in form of an inventory, it should not be shown in form of a receivable, because inventory is subject to market and operational risk, while the receivable is subject to credit risk. So these are the things that I'm just touching upon. Again, these themselves are quite detailed discussion points which need a lot of argument. But in a nutshell, I would be submitting that these are the things where we need to understand what is the right and truthful and faithful representation of the risk profile of the transactions and balances with regard to different parties. And those parties, from our perspective, actually include the internal virtual entities as well. Like what is payable or receivable from the participants might be different from what is payable and receivable by the institution in form of a Takaful operator. Profit and loss and balances determination in line with Sharia and reputation risk. All over the world, you know, the first argument against Islamic finance is, oh, it's all the same. You are just, you know, showing a different face, but it's all the same. वो कान घुमा के पकड़ लिया आपने, इधर से कान नहीं पकड़ा, उधर से घुमा के पकड़ लिया. some people say कि वो जी तस्बीह पकड़ा दी हाथ में तो it became Islamic. No, it is not like that. The point is that if you insist on doing the accounting similar to the conventional accounting, you create a reputation risk for Islamic finance, because Islamic finance is different and it requires different accounting. But if you insist on doing the similar accounting or exactly the same accounting as conventional, you end up having a situation where people will say, oh, there is no difference. But even by faithful representation, you are saying that, oh, we disregard this bunch of paper and we just do the accounting that we do for the conventional. So what is the difference? Where is the difference? So that is one of the biggest reputation risk. And this is very important, not for the regulators, accounting regulators and the industry regulators, to understand that even the reputation risk of the industry is very important, and this issue need to be addressed. How AAOIFI accounting principles are derived from the Sharia principles. So we also need to understand that when we say that we derive our accounting standards and we derive our accounting principles from the Sharia principle, from where it comes. So for example, the Sharia has Sharia principles, not accounting principles, with regard to timing of recognition of revenue. Because Sharia defines when a sales take place. Sharia says that sales takes place when a risk and reward is actually transferred. So, which includes the ownership and the possession and different elements. So the recognition of revenue cannot take place before that. Possession by the agent, Sharia, like IFRS, Sharia also defines what is the agency and principal relationship, and how and to what extent the agency and principal relationship are to be reflected in the financial statements. Combination of contracts, Sharia does not allow you to make two different, make two different contracts within one contract. And that is one of the principles that applies on the accounting side as well, that from IFRS perspective, you can say that some of the things are like, oh, this is all the same. So in substance, we combine all the contracts. Even IFRS at times, sorry to say, we think they are crazy. For some of the things, they say, break the contract. So even in insurance, they ask you to break some of the contracts. And in, like, for example, in some contracts, they say you need to break the contract and identify the embedded derivative separately. And in some of the contracts, they say, oh no, combine the contracts. Like, for example, combining a lease, finance lease contract. So you say that sale and lease element need to be combined. Again, my purpose right now is not to criticize IFRS. They have done very, very fine accounting work, that thanks to them. I'm just saying that at times different approaches are applied to different type of transactions. And here we need to understand that if there is a Sharia compliant transaction in which it is prohibited to combine the contracts together. So the Sharia requires here, for example, the PTF part and PIF part to be separate. And Sharia requires that wakala fee is a separate element. So if you say, no, we want to combine it all together and want to apply IFRS 17 on all of it together, this is something which is against Sharia and which is against the faithful representation of the business model of the Takaful business. Discounting prohibition, Sharia does not allow you to discount anything which is established, receivable or payable. Since riba is not allowed, if there is no riba, there is no interest, there is no opportunity cost of capital. And if there is no opportunity cost of capital, then there is no discounting effect. It should always be zero. But what are the situations in which a different type of a discounting approach can be used? So these are further details that we are going to discuss later. But in a nutshell, established receivable and established payable are not allowed to be discounted or accreted in value by Sharia. Quasi-equity is a different concept that which is not addressed by IFRS, that there can be transactions, and there are transactions in Islamic finance which have an equity element. And primarily they have an equity element, but they also have a liability element. That is because of having a put option, they have a liability element. While from IFRS perspective, anything having a put option becomes a liability by default. But in Islamic finance perspective, some of the things actually are considered to be quasi-equity, because they are primarily having the equity element, that is, they share the profits and losses and the residual interest in the net assets, while they have a put option that makes a liability element in them. And that's why we say that they are not like normal equity, but rather they are a form of quasi-equity. Again, as I mentioned, some of these topics are like, going to take time. Now, a very quick thing about some of the issues before we come to the point. Now, question is, what could go wrong if proper accounting is not done? So I have just bullet points. I'm not going to take your time on that. Rights and responsibilities of the stakeholders in line with Sharia principles and rules and in accordance with the business model and the contractual arrangements is not established. Profit and loss distribution between the relevant parties not carried out in a Sharia compliant manner. And again, I would say not in line with the contractual arrangements and contractual rights and obligation. Improper recognition of revenue results in illegitimate profits. Incorrect timing of revenue recognition results in improper recognition and re-recognition of assets, etc. Transaction trails as per Sharia and principles and rules is lost, and hence Sharia compliance become weak and Sharia audit difficult. Financial statements will not show true and fair view of the financial position and performance of the institution and different subsets of the institution, and risk profiles of respective assets and liabilities, etc. are not reflected in the right way. Another question that people ask is about having the right disclosure. Okay, no problem. We do the accounting as per IFRS, but we'll do the right disclosure. This is the treatment that has been followed by some of the countries. And I have seen even our brothers in Pakistan from ICAP having some of them having this argument that there is no harm in doing IFRS accounting or any other conventional accounting, but we will do the right disclosures. But let me take you to the main core principle, even within IFRS framework and in any framework of accounting, that fundamental accounting treatments, if they are wrong, you cannot remedy them just by making disclosures. So it is not if it's sufficient that we say, oh, we do the accounting exactly as IFRS 17, but we'll do some disclosures to show, okay, it is Takaful, it is not conventional insurance. But I'm sorry to say that even in the core accounting principles under any framework, the wrong accounting treatment, wrong identification of the rights and responsibilities, wrong and incorrect risk profiles reflected in the financial statements cannot be just made good by making some disclosures. So this is, again, one of the arguments. I know that today time is limited and I don't want to discuss a lot about AAOIFI, but since some of you are completely new to AAOIFI and may not have any idea about what AAOIFI is, so I need just 3 to 4 minutes on this from your time. AAOIFI is the Accounting and Auditing Organization for Islamic Financial Institutions. It is an industry body represented by industry and regulators. We have 166 active members in 37 countries. This is only the list of active members. Total list of members goes up to 250 plus. We develop standards in 5 areas through 3 technical boards. We have a Sharia board, which develops accounting with Sharia standards. But our Sharia board also, through a committee or directly, reviews our accounting, auditing, governance, and ethics standards as well. Which means that when we say that our accounting standard is issued, it means that it reconciles and follows the Sharia standard of AAOIFI. So it is not that, okay, this is something done by only on the accounting side. No, the Sharia aspects of this accounting are reviewed by a permanent committee of the Sharia board. And if there is a major issue, it is taken to the Sharia board itself. So according to the AAOIFI's standard development mechanism, every standard is endorsed for Sharia, even if it is not itself a Sharia standard. So the accounting, auditing, governance, and ethics standards, which are issued by our accounting board and by governance and ethics board, are also subject to Sharia review. Our standards are adopted in more than 40 jurisdictions in more than 35 countries. I'll come to quickly to that. This is a little bit about AAOIFI, so I'll skip that. Just to give you an idea about from this slide about the level of adoption of AAOIFI's standards. So just to give you an idea, our Sharia standards are adopted in different forms. Like one country adopt them as part of law, 17 countries adopt them as full adoption, and then partial adoption, guidance, reference material. There are different stages. So these are the classes of level of adoption. And from that perspective, you see that there are 41 regulators or jurisdictions in 38 countries that adopt Sharia standards. For accounting, there are 47 regulators and regulatory bodies in 36 countries. and there are 41 in governance. On the governance side, there are 41 regulators or regulatory jurisdictions in 41 countries that fully, partially, or in some one or another form adopt our standard or refer to them. Now, coming to our subject, and I know that I don't want to take any questions about AOFI or earlier discussion points that we have, but now onwards, obviously, I'll prefer that after every section I complete, we open up the floor for discussion, at least to take 1 to 2 questions on every section. So first, I'll take you through the business model. I can well understand that most of you already know it, but we need to understand the model again as to how the model works and how it needs to be reflected on the accounting side. So a Takaful institution consists of the Takaful operator, the participants Takaful fund, and in case of family Takaful with investment products, participants investment fund, PIF. So we have Takaful operator, PTF, and PIF. The Takaful operator has a principal agent relationship with the PTF for underwriting operations, under which they manage operations under a Wakala contract, receives Wakala fee from PTF against managing the underwriting operations, funds the PTF in the event of a deficit through Qard Hasan. This is a temporary funding. We are going to discuss this part going on. So that is the first part, the underwriting part. The second part is Udarba or management agency contract with the PTF for investment management. So the funds within PTF are also managed and invested. And for that part, the Takaful operator works either as a Mudarib or as a Wakil to manage those investments and get a return on that part. He can be entitled to a profit-based return on this one, but not on the first one. This is very important to understand that the profit-based element on the first one is not allowed, but the profit or based element on the second part is allowed. The third part is where the PIF is there. Where the PIF is there in the family Takaful with investment feature, then he also has again Wakala fee or Mudarib share from PIF. So again, that is all based on a profit sharing model. But again, all the three, all of these, he doesn't take a loss. There is an argument that through Qard Hasan is taking a loss. Technically, that's only a temporary funding, not a profit and loss entry. So from Sharia's perspective and from the business model perspective, Qard Hasan is a temporary funding provided, and it's not a compensation for losses. It is a compensation for funding shortfalls on a temporary basis, which is to be paid back as soon as possible. The next part is Takaful Participant Fund. It has a principal agent relationship with the operator, is a virtual entity as per Sharia and or a legal entity as per Sharia as well. As per AOFI standard, it's a legal entity, and in Pakistan, normally it takes form of a waqf, which makes it a more stronger legal entity. Attributes entire surplus or deficit to the stakeholders, participants. My apologies for this typo error. Pays Wakala fee to the Takaful operator against management of underwriting operations. Receives Qard Hasan from Takaful operator and records it as a liability. Pays Wakala fee based on fixed and variable with incentive to Takaful operator against investment management only. Then on the PIF, maintains the investment component of the arrangement in case of family Takaful products with investment feature. It's a virtual entity, maintains separate accounting records, and has a Wakala fixed variable with incentive or Madarba contract with the Takaful operator. So there are three different structures within the I would say sets of stakeholders within the Takaful business. Now coming to the core differences. Takaful is a risk-sharing business. Conventional insurance is a risk transfer business. In conventional insurance, the contract is between the insurance company and the customer or the insured person directly. While in case of Takaful, it's a collective contractual arrangement of the PTF with the participants. Now, this makes it a huge difference. According to Sharia, for those who do not understand this difference, why it becomes permissible and why it is not permissible, according to Sharia, in a commutative contract or an exchange contract, if you have a gharar, which is, gharar in that can be considered impermissible. While on the other hand, if I pay in a commutative or exchange contract, if I pay 100 and get 150, or get 200, it is a form of riba also. according to most scholars. Some scholars don't consider it. Thirdly, there is an element of gambling in that, particularly when it is an exchange contract. Now, if you replace the exchange contract with what you call a participatory contract in a form where a mutual insurance type or cooperative insurance type mechanism is created, in which the exchange contract is replaced with a non-exchange contract we call tabarru contract. Tabarru contract means that I give up my right in favor of all of us combined. So effectively, the exchange contract which was there in insurance is replaced with a non-exchange contract or a tabarru contract, non-commutative contract as a fundamental, as a starting point, which changes the business model. So now the insurance company, instead of becoming insurer, becomes only a manager. So that is the insurance business and this is the management business. Insurance model works on risk transfer. Takaful model works on risk sharing. So insurance company is the insurer or underwriter. Here PTF is the insurer or underwriter. Takaful operator is the manager of the underwriting business, while in the conventional insurance, there is no such manager role. Surplus is attributable to the participants only. This is a very important point. I know it is not less happening in the general Takaful, but in the family Takaful, even in Pakistan, the surplus is being attributed to the participants, which is not exactly happening the same way in the conventional insurance. And I know you just 2-3 days back, one of our colleagues shared that in Nigeria, one of the Takaful companies actually passed on the surplus to their participants. One of the very experienced accountants leading one of the big four in Malaysia and being a past president of the Accounting Standards Board, he mentioned to me that in a meeting, he mentioned that he enjoyed, although he was propagand of following IFRS on Islamic insurance without any separate set of standards, but he said that I enjoy getting a surplus being paid back to me. I remember people in Sri Lanka mentioning that the first Takaful company in Sri Lanka actually used to pay back the surplus element to the participants, which made it an incentive. Again, I do not want to go to the challenge the market practices right now. But I can tell you that those who understand the calculations, they know that even under the family Takaful in Pakistan, surplus is being actually paid back to the participant. That is one of the most important elements that does not apply in the conventional. On the other hand, the deficit also goes to the participants or collectively to the participant fund, which means that a Takaful operator is not taking the deficit. According to Sharia, it is permissible that he temporarily funds that. And normally the business model and the regulatory requirements require the Takaful operator to give Qard Hasan. Now, Qard Hasan is a temporary funding. And obviously, I do not want to challenge the governance issues in the amount of Qard Hasan and amount of Akala, etc. right now. I just want to say that according to the business model, according to the Sharia, according to the regulations, Qard Hasan is a temporary funding which is supposed to be paid back, and it's on a non-interest bearing basis. And in the conventional, the losses are all taken by the shareholders directly. Considering these differences, we need to understand that this need to be reflected in the accounting as well. And if you think of just, it seems to be very easy that, these are the differences, we'll reflect it in accounting. Oh, sorry, you can't just reflect it in accounting by disclosures. Actually, you need to determine the right accounting treatments for the risk sharing part, for the management part, for the fee recognition and revenue recognition part, for the deficit accounting part, for the Qard Hasan accounting part. You need to consider all these things in a proper way so that these are reflected in the right way in the financial statements of the institution. So the question about, again, is it really different from conventional insurance? The arguments of no, in the nutshell, it is the same. I know people have this argument. They believe that it's just a product. You just change the bunch of paper, everything else remains the same. I know people who believe in this and who do this. Sorry to say, unfortunately. And obviously, there is a very strong argument on the technical side that Qard and certain other regulatory requirements make it the same. This argument to me is on technical grounds is stronger than the first argument. The first argument, I don't buy it at all. But the second argument, I know that it has some merits. Arguments for yes, if it is not different, then why it exists? Just to make fool of people, sorry to say. Maybe, yes, for some of us, yes, maybe. But maybe it was not the intended purpose. The intended purpose was that to find a solution that works in a similar manner than conventional assurance to achieve the same objectives, but which works in a Sharia compliant manner, and that is the purpose. Can only change of documentation justifies for Sharia compliance? I talked about it, and fundamentally risk sharing is different from risk transfer. That is a very important point that we should never forget. So if you consider the risk sharing being different from risk transfer, then you might need to find solutions where you have to find the accounting differences. Now, we have completed the first section here. And in this first section, I just want to quickly have some questions. Maybe we can take 1 or 2 questions here. Let me stop sharing here and see if anybody is raising hand or putting question in the. We don't have a Q&A tab, so maybe you can put question in the chat window or raise your hand. Maybe it's after lunchtime, so everybody's sleeping. Or I speak a lot, maybe, making everybody to sleep. Okay. So no question means, I don't know whether no question is a good thing or a bad thing, but right now we have no question. So let's move ahead. And now coming to FAS 42 and 43 and overview. And so we are having some summary of accounting treatments here. It's just a summary accounting model, sort of how we do it. So we have management and fiduciary capacity as agents. So we distinguish the Takaful institution from participants Takaful fund and the participant investment fund. We consider both of them as virtual entities, and we require their financial reporting. Then we have this Takaful arrangement. Okay, one thing, we are not calling it a Takaful contract. We are calling it Takaful arrangement because it's a combination of different, it's a mutual contract between PMD, between PTF and the participants in form of PMD, participant membership documents, but it's not like a conventional insurance contract or a policy. So we have used the term Takaful arrangement in the standards as well as in this presentation. Then obviously you need to recognize it, and Takaful component is to be recognized in the book of the PTF. And if there is a non-Takaful component, then you need to segregate if it is in form of a product or service, and it has to be accounted for in line with relevant FASs. If it is done by the insurance company, Takaful company, then it will be in the books of the operator. And if it is by the fund itself, then it comes to the fund. Takaful arrangement is segregated and bundled for that. And then we have the wakala fee element. The wakala fee for services and initially or already delivered are to be accounted for immediately, delivered over time are to be accounted for over a period of time. And if there is a probable refund of wakala fee, you need to keep a provision for that. The level of aggregation is something similar to what IFRS have. There can be an argument in practical application because the surplus distribution, would it be considered as a cost or it will not be considered as a cost for that purpose or a cash outflow for that purpose. We have not considered it a cash outflow for that purpose, and from that, because otherwise everything will become zero. These are some of the confusions that may apply in in literal application of IFRS 17, that a surplus may be considered as a cash outflow. So eventually there will always be zero CSM. So there are challenges like this. I'm not going to each of the challenge right now, but I'll just mentioning that arrangements that are are having a surplus element, those having a onerous element, and those having a significant possibility of no significant possibility of turning into onerous means that having a surplus element. The other ones are onerous. This means that they are in deficit situation. And in some of the specific challenges related to Takaful are also addressed by these standards. Let me just mention that, for example, if in Takaful you are having onerous contracts, onerous arrangements, then a first question that is raised on accounting is whether you are a negligent agent. If you are charging too much of the wakala fee and making after payment of the reinsurance or Takaful premium, immediately the balance becomes negative, then the question comes on your governance. So the question, governance and application as an agency. So this is what I'm just mentioning, that this is one of the specific challenges that may apply, and this is one of the things that we address in this standard. Just try to understand the minute details that actually have to be considered while accounting for these products. Then income and expenses against provision for carrying amount of for the liability expense, for incurred claim, that expense increase in liability because of claim and expenses incurred in the period and representing subsequent changes in the Takaful fulfillment cash flows. Then we have the provision for Takaful arrangement shall be measured of the total of the fulfillment cash flows and the residual margin. The Takaful residual margin is a term different from the contractual service margin, but it is we will come to the definition part of it. But we have used the term Takaful residual margin being different from the contractual service margin, because contractual service, first thing is contractual service margin presumes that you are providing a service directly. While in the PTF, you are not providing a service, you are rather actually having a mutual risk-sharing arrangement, which means that it is about residual margin and not about the service margin. And this is just, again, some of these things I'm touching upon. These have their own minute, you will say, oh, what difference does it make by changing the name? Actually, there are some additional elements when we apply them in practice, they become different. Like I gave you example of the surplus, that surplus might be considered in the literal application of IFRS 17. Surplus may be considered as a liability and as fulfillment cash flow. So this will result in always zero CSM, and accounting will become more complicated. Otherwise, you will do purely the conventional accounting. Now there are if you do pure conventional accounting, that is something different. But if you try to say, oh, we will do IFRS, but we'll try to apply IFRS literally to the Islamic finance transactions or to the Takaful transactions, you end up having confusions. And the purpose of having AOFI's accounting standards is actually to solve those confusions and to bridge between the conventional IFRS and the Sharia principles and rules. So you have the future cash flows related to wakala fee and future cash flow deferred cost element. That deferred cost is the discounting element. Other future cash flows at fair value and risk adjustment for the non-financial risks. Then we have the estimate of fair value of the cash flows. So you are actually you have to consider for the future cash flows, you have to consider wakala fee as a payable amount because it's a contractual obligation that is to be paid, and surplus distribution or qard hasan are not considered to be part of the future cash flows. Like inflow in form of qard hasan is not considered to be part of inflows, and surplus distribution is not considered part of the outflows. The estimate of future cash flows shall be adjusted with the sustainability margin of the PTF. To reflect the sustainability margin of the PTF. Now, core accounting treatments, other than the things that I'm going to discuss here and identify the difference, going forward, I'll have some slides on the treatments and some slides on the core differences that come in the treatment going forward. Right now, we are just having a very quick overview of the working model. Then we have the Takaful residual margin, which is a replacement of the conventional CSM. It includes the Takaful fulfillment cash flows. But again, even even for the cash flows item, you need to consider that fulfillment cash flows are for the purpose of first, let's distinguish on the acquisition cash flows. So the acquisition cash flows for the Islamic insurance or Takaful industry might not be all relevant to PTF. Some of them might be relevant to PTF, and some of them might be relevant to the Takaful operator. So while it is allowed that in some cases the commission may be paid by the PTF if the wakala fee is on a lower side and the operator is not taking the commission element outside of it. So in that situation, actually, you can have cash flows including commission. But on the other hand, if the wakala fee is on the higher side and the commission is on the hand of the Takaful operator, which we believe should be in most of the situation. And the regulators also are around the globe, actually, regulators are insisting on that the commission should not be paid by the PTF, but it should be paid by the operator. So in that, out of the wakala fee. So in that situation, we distinguish it from the Takaful acquisition cash flows versus the Takaful acquisition service cost. So the costs that are incurred by the operator are the Takaful acquisition service cost that is not subject to the accounting within the pool and is to be subject to accounting by the operator separately. While within the pool, the Takaful acquisition cash flows that are attributable to the fund itself are to be considered here, and obviously then they will become part of the total fulfillment cash flows and all that. Onerous arrangements, again, the accounting for onerous arrangements is more or less similar to what we have in the IFRS 17. So the accounting is more or less similar. Subsequent measurement, there is one element that might become different, as that liability for incurred claims, which becomes established payable, will not be discounted, while on the other. So this is again not going to normally be material, because when it is incurred, it becomes material. There is one element that is which interpretation is not very clear, and that's about an incurred claim, which is about a long-term payment over a period of time, like education plan, which requires a payment over a period of 5 years. So is it an incurred claim or not? These are some of the matters that are to be interpreted according to the respective Sharia interpretations. But otherwise, the rule is that incurred claims will not be discounted, and the total provision will include the incurred claims and for the remaining entitlement period. And it's not the claim entitlement, we say that is the benefit entitlement. Some of the minor terminology change are actually changed conceptually the things. Income and expense against provision for remaining entitlement period, the expenses representing losses and reversal of losses on onerous arrangements, amortization of deferred cost as the discounting effect, and amortization of the Takaful residual margin over a period of time. Simplified approach, that is the contribution allocation approach, is also allowed in a similar manner. So obviously you will have the same accounting similar to what you have, except for the presentation will change in line with the new standard. For the initial money paid to PTF, some of these specific items, we have the recognition criteria as to how it will be accounted for. The Takaful surplus and deficit, how is to be accounted for and distributed. The standard, particularly for surplus distribution, is aligned with the Sharia requirements, and particularly those contained in AAOIFI Sharia standard. Again, surplus distribution, something to the extent of surplus being contractually payable versus the surplus being discretionally payable. These accountings will be different slightly depending on the nature of the contract and nature and the Sharia board's views with regard to these things. So if the surplus to 100% extent is to be contractually paid at the end of the financial period, it may be immediately recorded as payable. But in other situation where the discretionary element is there, it will always be done when it is declared, and obviously it will become a liability when it is allocated to each individual participant according to whatever formula is there. And obviously those formulas, as aligned with the Sharia requirements, are contained in the standards. Qard Hasan accounting, IFRS obviously does not address this aspect. AAOIFI standards 42 and 43 address the Qard Hasan accounting properly. One of the most important element is that Qard Hasan accounting includes the provision or allowance for impaired receivable element as well, expected credit losses item. So the concept is that if you have receivables going in excess of the recoverability, so the disclosure requirements are there with regard to the future expected outflows for Qard Hasan, that as to how much and to what extent you have amounts payable that are to be paid. With regard to the write-off, etc., we have addressed those issues as well. Again, these are the elements which are not covered in the IFRS, and to some extent they actually may change the accounting as well. For example, I'm just putting an example just to explain The literal application of IFRS 17 would require that Qard should be considered as an inflow, because you are doing it primarily on a consolidated basis, considering the substance over form, considering that Takaful operator, because of Qard is actually taking the whole risk. And from that perspective, the Qard will be considered as part of the inflows as well. I'm just mentioning some of the things that completely change if you apply IFRS in literal. Now, this argument is still there that, okay, you apply IFRS and then do the local regulations distinguishing the requirements. Then I can tell you, you will more or less reach where this FAS 42 and 43 is, because this is actually trying to align the Takaful accounting with IFRS 17, considering Sharia requirements. The transitional provisions are there with regard to, similar to IFRS 17, there are transitional provisions. I'm not going into detail for these. Again, I know that I'm being very quick and very fast, but, you know, I know that this is something that, you know, a long subject on which we had days-long, dozens of meetings. It all cannot be done like, you know, in 2 hours or less than 2 hours. So I'll just touch upon some of the key definitions, then I'll hand over to my brother Harun Tabriz to take you through the requirements of the presentation and disclosure for the financial statements. Because definitions here, there are too many detailed definitions, but I'll touch upon some of them again. I will request the ICAP team later to, like, you know, ICAP and IAP team to share the presentation with you guys. Our colleagues will share the final version of the presentation with you, inshallah. Now, the key definitions. One of the important element that need to be corrected, that need to understand, is that some of the definitions have different terminology, and those terminologies, while people will say, oh, what difference does it make? But actually it makes a difference. For example, the claim is replaced with benefit. Now saying, oh, no, it's not a difference. No, the problem is that benefits that are as per entitlement of the PMD contract or the PMD documents, that is not exactly as a conventional claim. So some of the things are actually, again, even if their accounting might not be significantly different, but some of these things actually reflect the nature of the transactions. So again, the contribution, we are using contribution instead of premium. It is already being used in Pakistan, you know it well. So it is, the contribution is the gross amount. Entitlement for benefit, entitlement period. These are the terminologies which are slightly changed and actually are entitlement for benefits period. These are the terminologies that are actually changed and reflecting the true nature. Now, fair value of future cash flows is something important that we need to understand one concept here. As I mentioned earlier, that Sharia does not allow you to discount any established receivables or payables. But what about the provision that I'm creating for the future liability? Can it be discounted? According to Sharia, since it is an estimate of a liability that covers over a period of time, there is permissibility in line with good accounting practices to discount it. So, but we do not use the term. We do not use the term discounting because we do not believe in interest, and if there is no interest, there is no discounting. So we have the definitions amended according to Sharia and reflecting Sharia. So, for example, the definition here says that fair value of future cash flows in the specific context of this standard of an asset or provision not being an established debt, whether receivable or payable, is the estimated value equivalent to the fair value of an otherwise permissible exchange of an asset or liability having similar cash flows with a knowledgeable willing party on an arm's length basis. Explanation. For avoidance of doubt, it is clarified that the estimate of such value may take into account considerations applied in similar transactions, including discounting of cash flows to arrive at the fair value acceptable to such counterparty. This is just an example to distinguish, like, some people will say, what difference does it make? You just change the name. No, actually, we did not only change the name. I don't want to go in this argument, but there are elements with regard to this sort of accounting. So for example, we do not use the effective interest rate method. We use the effective rate of return method. You will say, what difference does it make? First thing is, effective interest rate method implies that there is time value of money, while effective rate of return method implies that there is time value of economic resources, not the time value of money. Similarly, the timing of recognition of revenue might be different in case of time value of economic resources. So when we apply the effective rate of return method in case of, for example, Ijara transaction, the Ijara transaction related profits recognition does not start from the date when you get out of funds. Rather, it starts from the date when you actually deliver the asset to the customer. So these things at times are similar to conventional, but they at times have minute details that are different from conventional. And these are the details which actually distinguish Islamic finance transaction from the conventional transaction. Liability for incurred claims for benefits and onerous arrangement. As already I mentioned that instead of insurance contracts, we have used the term Takaful arrangements, which include more than one contracts at a time. Participants investment fund, participants Takaful fund, these are defined. Provision for remaining entitlement benefit, Qard and Qard Hasan are defined. Reinsurance, Takaful, we have defined them in detail. Risk adjustment of non-financial risk. Again, the accounting treatment here is more or less similar to the conventional. We have a Takaful detailed definition here. I'll just read it because I have discussed with you the Takaful business model. I think I should have taken it there. Takaful is a process of agreement among a group of persons, commonly referred to as participants, to handle the losses resulting from a specific risk to which all of them are vulnerable. A process thus initiated involves payment of contributions and donations and leads the establishment of a Takaful fund that enjoys the status of a legal entity from Sharia's perspective and has independent financial liability. The resources of this fund are used to indemnify any participants who encounters injury subject to a specific set of rules and is given access to the process and a given process of documentation. I'm sorry. The fund is managed by either a select group of participants or a joint stock company that manages the Takaful operations and invests the assets of the fund for an agreed fee. So this is the main definition. Takaful acquisition cash flows and Takaful acquisition service cost. I touched upon these things. The definitions are provided. Takaful arrangement I mentioned already is a combination of a non-commutative investment and other contracts. Takaful fulfillment cash flows, we mentioned about this thing, and the Wakala fee to be PTF is part of this. And while I mentioned earlier, that surplus distribution and Qard Hasan are not part of it. Takaful institution, we identified that institution as a whole and operator. So we distinguish between institution and the operator. Operator is the manager part of it. An institution, we say that is the combined institution that includes the sub-entities. Takaful residual margin, I mentioned that it's the replacement for contractual service margin, but let me explain, is the component of the carrying amount of the asset or liability for Takaful arrangements or group of Takaful arrangements representing the unearned surplus or at times unrecognized net cost applicable in case of re-Takaful arrangement held only. The PTF shall recognize it as it provides benefits under the Takaful arrangement. Explanation: the Takaful residual margin is a risk-sharing Takaful business is from an accounting perspective quite similar to contractual service margin under the conventional risk transfer-based insurance business. Then we have definitions for Wakala and Wakala. Now we'll come back to the core accounting differences that are there. We have gone through the main business accounting model and these things, but before that, I think one very important element is about the presentation of financial statements. In Pakistan, already we have a different set of accounting financial reporting, not exactly as IFRS according to the Takaful accounting regulations that are already there and in line with the Takaful Rules 2012. I believe that the new set that we are talking about will fulfill most of the requirements under Pakistani requirements, except for, I think, the statutory fund. because the Insurance Act ordinance has the statutory fund thing. So we need to have a bit of local guidance with regard to the statutory fund accounting. Other than that, I think that most of the requirements, personally, I believe that whatever we need in Pakistan is actually covered here. So here I would like to hand over and take some rest, hand over to Brother Harun Tabriz. Brother Harun is also a chartered accountant. He has been a Director Technical and Quality Assurance at ICAP earlier. And right now he's Chairperson for Accounting and Law Department for IBA, and a member of the Sharia Advisory Committee of SBP. And he's a consultant for AOFI and was part of the team that developed these two standards. So I hand over to Brother Harun. Do you want me to continue showing the presentation, or you would like to show it from your end for this section of presentations?
I can show it from my end,
okay.
But if there is any question, we can give participants some time.
Oh, for sure.
Yeah.
What we will do first, any questions with regard to these definitions, etc., we can take, and then we can we can go to the presentation part, which Brother Harun will take us through. You know, this thing I say at times that either I'm too good or everybody's sleeping. There are only two choices because there are no questions coming in.
What's up? I'm from what's up? Sorry, I am from State Life. My name is Mohammed Rashid, CFO State Life. My question is regarding to the commission, treatment of commission when it's a part of wakala fee. I mean, we are charging a higher amount of the wakala fee. So what should be the treatment under this new FS standards?
Excellent question, sir. Excellent question. Actually, for most part of the accounting that we do on the Takaful operator hand, we do it as per generally accepted accounting principles, which are quite similar in IFRS and AOFI. So the revenue recognition is mostly similar to IFRS 15. We have the same 5-step model in our framework. So more or less it is the same. So we have defined that wakala will be considered according to the fee that we have, according to the nature of the fee that we earn. It means that wakala at times is earned for services that are already delivered. So I did some marketing services, I did some other sales related services, I did some initial medical testing and other things. So all these things that I did for the initial part, I did it. So this part of wakala will be recognized immediately. There is some part of wakala that is related to the costs that are incurred over a period of time. So the cost that is incurred over a period of time may include, for example, the claim management cost, underwriting business management cost, administrative cost, the accounting and bookkeeping cost, and claim handling cost, etc. So these things actually are to be incurred by the operator over a period of time. So these are to be recognized over a period of time. The third part is that if there is an element of refund of wakala, if there is a refund of contribution to the customer, then to some extent there is according to the contractual arrangement, there can be a element of refund of wakala. So to that extent, to the expectation of the refund levels, to that extent, you need to keep a provision. Now, this applies the matching principle, which means that the commission, generally, if you follow the same approach, so the commission for the person who actually comes to you and says that, okay, this is this is my money that is because I delivered you the service, I got you the customer, so my money is legitimately entitled today. So in that situation, if there is no refund element, if there is no ongoing service element, the correct and preferred accounting is that it needs to be immediately recognized as an expense, and it's to be the related wakala fee to be immediately recognized as revenue in the beginning. Now, this is the main treatment. However, the standard allows capitalization of costs for some period. Again, some of the details are quite minute. I request Brother Harun, let's make a note of this point and we'll send you directly this point that the standard allows deferment of that cost if both are deferred, like revenue and cost. But the preferred treatment and the main treatment is that it becomes legitimately due and it becomes legitimately earned, immediately to be recognized.
Another question, Omar sir, another question my colleague is asking is from a state lab. It's qualified actually. So kindly, Jay.
Yeah, in the current, according to our ordinance and the SECP rules, there is a provision for mis-selling. Like if the contract has been mis-sold to the customer, so he has a right, at least for about 1 to 2 years, he can claim and the policy can be cancelled. So in that case, how would the standard treat this point?
Okay, actually, to be honest, it's a good point. We have not covered it specifically, to be honest. The one part is covered, that is contribution refund option. And if you have a contribution refund option, then you need to have a contribution wakala fee refund option. So wakala fee refund option, for that we have said that to that extent what is expected, not total amount payable, because all customers in that, let me put another example. I remember I was auditing one of the major pharmaceutical companies, and there was an argument about sales return, that if the product becomes expired, then you need to have the return. So there was an argument whether the sale take place at all or not. You got my point? Their argument was that I made sale of 10 billion rupees, but I have a legal liability that even if 100% of the goods are not sold till the expiry date, I will have to take them back. That is my contract. So the question was, shall I not record any sale at all and only record the secondary sale, which means that that is sold by my wholesaler or my retailer to the eventual party? So the argument was that no, in the normal course of business, the sale has taken place. So you do the normal accounting. But you keep a provision that what is the expected amount of reversals. What I believe the answer, while this issue is not exactly addressed in the standard, but the principles provided by the standard actually cover it. So number one, for me, I think when you do the calculation as actuary, when you do the calculation of the cash flows, obviously you do the cash flow calculation on both ends. So when you do the cash flow calculations in the fulfillment cash flows, you might need to inbuild that calculation. So that is the PTF part. And because the principles are there, anything that is expected to be paid, obviously you need to keep it part of the fulfillment cash flows. On the other hand, for me, the wakala fee related refund part, we have already specifically covered. So for me, the principle-based answer is there in the standard, but this question as a separate question is not addressed anywhere. I think, Brother Harun, it's a good point. We can keep it a note of this question. While I believe that that the answer is there in principles, but maybe we can, if needed, because you remember we discussed it, that in going forward, detailed guidelines will be needed based on the questions that we are receiving day to day. And actually, not only from in your case, it is not yet implemented, but there are countries where they are in the implementation stage. So some of the insurance companies are actually having direct meetings with us who are our members. They're having direct meetings with us with regard to these questions as well. So I think we need to keep track of these questions and need to put answers to these in guidelines or FAQs.
Okay, thank you.
I have a quick question, Omar Saab, if you can answer that. I wrote it in the chat as well. So at a very high level, can we say that the FAS 42 and 43 applies to the WACC fund only?
Okay, answer is that FAS 42 provides financial statement presentation for operator and fund both. So it means that 42 applies to all. Now coming to 43, 43 applies 90% only to the fund, but there is a separate chapter in 43 which addresses the ancillary transaction, which means that wakala fee transaction, qard hasan transaction, seed money for waqf, etc. So these are the specific issues which address both operator and the institution. So the answer is 42 addresses both. 43 addresses 90% to the PTF, but 10% to other elements also.
Perfect. Thank you so much.
Okay, if we don't have any other question, Brother Harun, I think you can take it forward. And then in the end, we'll come back to some of the core differences again. So Brother Harun will take you through the presentation of financial statements, that how many financial statements are there and what are the contents of them. And obviously, we can take questions on that. Brother Harun, please go ahead.
Right. Bismillah ar-Rahman ar-Rahim. We have discussed that we have three different virtual entities, I would say: the Takaful operator, the participants Takaful fund, and the participants investment fund. So the financial statements are based on the three virtual entities. We would have certain statements for the Takaful institution, the operator, certain for the participants Takaful fund, and certain statements for the investment. You can see in this slide that we have a statement of financial position of the Takaful institution, statement of income and other comprehensive income for the Takaful institution. You can have it as one statement, or you can have two separate statements. Then we have a statement of changes in owner's equity of the Takaful institution, the operator itself, the statement of cash flows, and statement of financial position for the managed PTF. This would be separate for the general and the family Takaful fund at the end of each reporting. Then the income statement has been renamed to statement of financial activities of the managed PTF. This is because we thought that it will not be correct to classify it as profit and loss or income statement. It is actually a statement for showing activities performed by the managed PTF, and these statements would be separate for the general and family. Then we would have a separate statement for the managed participants investment fund. This would actually include the investment side of the funds, and then the notes itself. First, discussing the statement of financial position of the Takaful fund, and the asset side, the liability side, the quasi-equity side, and the equity side would be separately identified in these situations. So the Takaful institution would show balances from other institutions and Islamic banks, the deposits which are placed with the regulators. This could also include the statutory deposits, the receivables which are from the managed PTF and the managed PIF. Thus, if it is receivable from the managed PTF, and this should be after the allowance for impairment. Brother Umar discussed that for Qard you need to have expected credit risk approach also. Then you would be showing the accounts receivable, investment in associate and joint ventures if there are any, investment in real estates if there is any by the institution, investments in sukuk, in shares and in other securities, property, plant and equipment, and you would show the disclosures of significant items with accumulated depreciation. The right of use assets are the ijara assets which the institution has taken in from other institutions. These would be shown between the property, plant and equipment and intangible assets. Then you would show the intangible assets, income tax, which you would distinguish between the current and deferred, and the other assets which would be classified according to the significant types. In the liability side, the amount which is due to the participants, the Takaful fund and the managed PIF would be shown. If the institution has taken any ijara, the institution would need to show the gross ijara liability, the deferred ijara cost, and the net ijara liability. This is according to the new ijara standard issued by you. The provisions, accruals, and other liabilities would be shown, which would include the declared but undistributed profits, because Once you declare the profit, it becomes a liability. Before declaration, we will not consider it as an obligation. The zakah obligation, the income tax payables, and any other payables. Any amount due to other financial institutions and due to other counterparties would be classified next. And at the end, the liability type sukuks would be shown. After liabilities, we would have a separate section of quasi-equity. Quasi-equity is the classification where there is a put option as well as a characteristic of a liability as well as a characteristic of equity in the instrument. So certain sukuks which are of quasi-equity type would be shown here. If there is a financing based on musharaka or mudaraba where you need to declare profits, you need to give profits, it would be shown here. And investment accounts, which in an Islamic bank are referred to as unrestricted investment accounts. They are part of definition of quasi-equity. Usually we don't have them in a Takaful institution, but in a case where these are present, then you would show it as a quasi-equity. And the final part would be the owner's equity, which would have the subscribed and paid up capital. If there is a premium on issued shares, capital and other reserves, retained earnings, number of treasury shares held by the Takaful institution. And if there is any other component of owner's equity, for example, a sukuk, which is equity type sukuk, then you would show it in the owner's equity. The statement of income of the Takaful institution would have wakala fee, which is coming in from the participants' Takaful fund and the maybe from the participants' investment fund also. And from the participants' investment fund, you would be getting profits. Gain from income or gain from participatory investments, which are partnerships and investments in shares. Then we would show the income and gain from investments, which are carried at fair value through statement of income. These would directly come into income. If there is an income from off-balance sheet assets under management, which are other than the participants' Takaful fund and the participants' investment fund, then these would be shown separately, because any income from PTF and PIF is shown in number 1 at the top. Income from associates, other fee, commission, and related expenses, and other income would follow. Then you would have general and administrative expenses, which are borne by the Takaful operator. You would show net income loss before zakah and taxes a separate line item. Then income tax, both current and deferred, would be separately disclosed. Then a separate line item for zakah, then net income, and you would have other income at the end of the statement. Statement of changes in owner's equity would have capital contributions, net comprehensive income, and if there is a loss, then you would set it off. Internal changes in components of equity, if there is a bonus share of, if there is a change from reserves to retained earnings to the equity, and any distribution to the owners of the fund, and zakah paid or recorded as payable on behalf of owners will be coming in this statement. Statement of cash flows, we have not identified the format of statement of cash flows that the Takaful institution would actually make it on their own. But it would include disclose the net increase or decrease in cash during the period, and you would show the institution's policy of how you treat these cash and cash equivalents for the preparation of statement of cash flows. And if there is a disclosure required, you would show it as a footnote or a separate disclosure. Then we have statement of financial position of the managed PTF. Remember, we have to make a separate statement of the family and general PTFs. This would have financial position of the PTF's assets, liabilities, and net assets. The The participants' assets shall not be set off against each other. The liabilities and assets should be shown separately. And significant item of participant assets, liabilities, and participants' equity would not be combined on the face. They would be shown as separate line items. And if there is any amount or allowance which is established to cover expected losses or to cover the impairment, it should be separately disclosed. Liabilities and assets may be combined into groups for better understanding, but then it would be shown as a note in the disclosure. And subtotals where they are necessary would be disclosed in the statement of financial position. The next item would be the statement of the asset side of the statement of financial position. It would have cash balances with Islamic banks and other financial institutions, accounts receivable. If the participants, the Takaful fund has an investment in real estate or sukuk, it would be shown afterwards. They may have shares and other securities, any income tax asset. The proportion which relates to PTF would be shown in the statement of financial position of the PTF. Otherwise, the part which belongs to the Takaful operator would be shown in the institution's statement. Then other assets, deposits with the regulators, if there are any receivable from the Takaful institution, and contributions which are receivable net of allowance for impairment therein. If there is a contribution which is receivable, it will be shown. And receivables from Takaful, distinguishing between claims and commissions. Claims and commissions would be shown separately, net of allowance for impairment. The liabilities would include whatever is due to other institutions. If there is a current person payable to the Takaful institution, it would be shown as a liability. And we have also included that you need to show the significant terms and conditions and an expectation of when you would pay back this. The amount which is due to other financial institutions and counterparties would follow. The liabilities for incurred claim, including outstanding claims, and the claims that are incurred but not reported would follow. This would be one line item, but you can actually have different disclosures for each of them. Provisions for remaining coverage, which would include the technical provisions and deferred contributions. Then you would show the incurred claims and remaining coverage related to Takaful arrangements and Takaful credit balances, which would be divided into provisions, accruals, and other liabilities, declared but undistributed, surplus, income tax payable, and other payments. Then we have statement of financial activities of the managed PETF. This would have gross contributions, then any wakala fee and amortization of any deferred wakala fee, which would come as an expense. A Takaful share of contributions coming in or going out would be shown in the activity. Changes or movements in deferred contributions would be shown in this activity. Earned contributions, commissions earned from Takaful profit sharing commission, gross claims which are paid. This would be part of the statement of financial activity. Other parties' share of gross claims, which you need to pay to the co-insurers, co-Takaful. You would need to show it here. Takaful business acquisition costs would be shown here. Changes in outstanding claims and changes in the Takaful share of outstanding claims, which is part which would be taken to the Takaful. It will be shown in this activity. Then you would have provisions for outstanding court cases, if there are any, and this would be having a separate disclosure. Income from investments, where you would differentiate between the income from sukuk, from placements, from shares and other securities, and any fair value gains and losses on investments. These are coming in because we have separate standards in DOF for all of these products. Then we would have other income and Kard Hasan from the Takaful institution, which is written off during the period, would be shown as income, which is considered as hiba. Other expenses would be shown afterwards. Wakala fee of the party managing the Takaful operations would be recorded as expense. If there is any remuneration of the party managing PDF other than the Wakala fee, it would also be separately disclosed. Income taxes, both current and deferred, would be separately disclosed. And if there is a surplus on deficit due to the technical operations, it would be shown in this activity. Now, the statement of managed participants investment fund, we don't have a format for this. We have certain guidance. This statement shall segregate assets by source type, investment portfolios by types, balances of managed assets at the beginning, at the end, and the movement in between, the number of investment units at the beginning of the period, and the movement of it, additional investments or purchase of investment units by the participants, and it will be classified by each type of the instrument. If there is any withdrawal of investment or repurchase, then it would be deducted from this balance. And if there is any institutions share in investment profit as mudarib or fee, then it would be charged as an expense in this statement. In the disclosure side, any direct expenses which relates to the operations, for example, the acquisition cost of investment, it would be shown. Bank and legal charges, third-party management costs. If there is an allocated overhead expenses, for example, the Takaful institution manages investments and allocates certain overheads, it would be shown separately, disclosed. Consolidated surplus or loss for the managed assets during the period with separate line items for the amount resulting from the evaluation. This would be separately disclosed. And managed assets which are revalued and impaired, they would be separately disclosed. If there is a movement in profit equalization reserve or investment reserve, this would be separately disclosed. Participant investment fund may have profit equalization reserve or investment risk reserve according to the relevant FAS of AOFI. So if there are these reserves, we would show them separately. And the balance of managed assets at the beginning or and the end would be shown as a separate line. Then we will come to the general disclosures. These are normally the same as from the previous standard. Takaful institution shall disclose all material information for the users. They would give out the Takaful model. They would disclose the relationship between the Takaful institution and the managed funds. If there is a separate off-balance sheet transaction, you would actually give a disclosure of that too. A Takaful institution may have more than one fund, maybe more than two funds also. So each fund has to be separately identified and disclosed. A description of significant terms and conditions of the contracts between the Takaful operator and the managed funds. This would include Kard Hasan, how it is accounted for, the Wakala fee, and the share of Madarib. The disclosures would have accounting policies for these. The nature and activities of the Takaful institution, which is authorized by its charter, it would be identified. And very important that the Takaful institution's responsibility towards zakah, whether the institution itself is paying zakah or the Takaful or the participants are liable to zakah, this would also be disclosed. If there is any unusual supervisory restriction, then this would also be disclosed. Additional restrictions which are coming in due to Waqf model. or if there is any permissible structure and there are additional restrictions coming in because of that structure, then these needs to be disclosed. The solvency requirements according to the jurisdiction needs to be disclosed, and the concentration of Takaful and Takaful risks in the different geographical areas, sectors, and locations of the Takaful institutions, they need to be identified. The general disclosures include capital adequacy and solvency of the Takaful institution. This would be at the Takaful operator level as well as the PTF level. Any guarantees which are given by the institution which are not part of the PTF and which are given by the institution itself, they need to be identified. If there is a trust fund or any asset in fiduciary capacity, these would be identified and disclosed separately. And the managed PIF shall disclose the nature of relationship between the Takaful institution and owners of the investment, either as Mudarib or investment agent, whether there is a Mudariba agreement or whether there is a Wakala agreement. This needs to be identified with the rights and obligations associated with each type of investment. Now,
Brother Harun, if you allow me, there is one point on which I just noted, and I think you just overlooked that. The presentations somehow is one of the sections of the presentation is based on exposure draft, not based on the final version. So I apologize to the audience. I just noted that. So with your permission, I'll show that part. That is the statement of financial activities of the managed PTF. I think there will be, can you all see the screen, please?
Yes.
Okay.
Yes, we can. Yeah.
Yeah, the point is that unfortunately the presentation is not updated, so we'll share the final version with you shortly. But just to show you that this section will show like this. So the statement of financial activities of the managed PTF would have recognized the Takaful contributions. Now the exposure draft was based on the old version. This is the new version actually, which was aligned with FAS 43. So FAS 43 is talking about recognized Takaful contributions equivalent to what is coming as revenue in the IFRS 17 format as well. And then recognize the Takaful cost. So there will be breakups of that to be provided, like gross and gross receivable and all that. But with regard to the accounting will be similar to what is required in IFRS 17 and the FAS 43. So the total net recognized Takaful contribution will come here, which is actually the net movement of that revenue account that is similar to IFRS 17. Similarly, then you will have the Takaful cost and then net Takaful result similarly. So the disclosures will go to the notes, but the main format will be quite similar to IFRS IFRS 17 new format. So I just noted that unfortunately that only that slide, probably only that slide of the presentation was based on the old version. Not old version of the standard, rather the exposure draft of the standard, not the final version of the standard. So I just wanted to highlight this thing before we take the questions, please. So we have any questions on the presentation and disclosures generally?
So we is Naved here. So we have to show this assets and liabilities separately for the PTF and separately for the operators fund, or because I have seen. Yeah,
I think Naved, it's a very good question. Let me explain what is different from the current financial reporting from in Pakistan. First thing, in Pakistan, we have the revenue account in a way right now that first part attributes to the PTF. So we say that this part is attributable to PTF. Then we come down and we say that this part attributes to the shareholders. Now we are saying that as per AAOIFI, it was already, even earlier, it was 2 different pages. Even in the existing AAOIFI standards, which were before this one becomes applicable this year. So before that, the old standard, even if you might have seen in Middle East, etc., that is normally in 2 pages. So first thing is a statement of financial position, financial activities of the PTF becomes separate from the statement of income of the shareholders. While as of now, if you see the revenue account of under the existing Takaful accounting regulations and the format that have particularly for general insurance, the first part shows that these are the contributions and claims and all that, which is related to the PTF, and then we come down and we say it is related to the participant. So instead of up and down, we are having two different statements. This is the income statement. With regard to the assets, what was happening that we were identifying the assets by captions. We were saying that this is related to PTF. We were having single balance sheet, but we were saying that this receivable relates to, this is the claims, this is the contributions receivable, so it relates to PTF. This is the claims payable, which relates to PTF. This is like this. So this is, and at times actually receivable and payable between the institution and the operator were eliminated as zero. Some institutions were disclosing, but majority was not disclosing earlier, I'm sure, because earlier when I saw the accounts in more detail, in Pakistan, people were actually eliminating it internally. While here, you need to have the balance sheet separate for both, and the balance sheet has to show the receivable and payable, etc. So now we have more statements in terms of number. The question with regard to SECP's reporting, as we discussed in the working group, will still be there. That whether the SECP wants the reporting on the old format or they want the reporting on this one. But this actually reflects that being a sub-entity of the entity in PTF, of the main entity in PTF, PTF has its own balance sheet and income statements, SFP and SFA. While the shareholder and operator part has it separate, not consolidated, but rather reflecting the rights and responsibilities which are and obligations which are attributable to the shareholders, not including the ones related to the PTF. Current one is going for combined one. Why we are having this thing? I think some of the questions are related to control, which I have to discuss out of the core differences between AAOIFI and IFRS. So, but yes, answer to your question is this is separate. And these are distinguished now in this one. Now, PIF. As of now, PIF in those entities where we have, it is not being distinguished in this way. Now we have a separate statement of managed PIF, which is not asking for balance sheet and P&L separately. Rather, it's asking for a more like a movement statement showing that how much investments were available in the beginning under different classes, and then what is the movement ins and outs and gains and losses and Mudarib share, and then you reach the end. It is like this, sir.
So to sum up, like we have separate PTF assets and operators assets, and
Yes.
Same with the liabilities.
Exactly.
So just to understand, like, you know, we have this on the conventional side, we have those co-insurance contracts.
Yeah.
And I'm sure the same principle also applies in the Takaful, we call it co-Takaful contracts. So how your standard is treating those, because in that case, some of the cases, what has happened that you issue a contract as a leader, you as a lead co-insurer company, and you don't record the whole premium, but you only record your share of the contribution, but you receive the 100% of the premium to facilitate the client, because client wants, they don't want to deal a number of co-insurers. They say, okay, we'll pay the contribution to you.
Agree.
And you have to settle the claim as well on behalf of those other co-insurer, and then you can recover from them. And once you receive the contribution, you set off your receivables from your own share and book a liability. That's what normal practice is. How your standard is, how this standard is dealing all this situation. If you understand my question.
No, I understand very well. Thank you very much. So now there are 2-3 different things. First, very quickly, Takaful regulations, Takaful rules 2012 require that you cannot do it with conventional, but yes, you can, if you do with conventional, your documents and everything have to be separate. That is part one. Part two, if you have co-Takaful, and Takaful cannot be leader for co-insurance. You can be leader only for co-Takaful. This is requirement of the Takaful rules and requirement of Sharia. So this part question, goes away for us on the Takaful side, but still it remains a question in the hand of the Takaful insurance companies. But yes, you can still be a leader in a co-Takaful. Now, if you are leader in co-Takaful, that portion does not come part of your contribution, because the standard clarifies, in line with the IFRS framework, in line with the AAOIFI framework, that amounts received on behalf of others do not become part of the revenue. So they are directly recorded as liability. So that is part one. So the same applies to the claim, that whenever you settle it directly, a receivable payable account will go. We address this issue not in that much detail, but we address the issue. The receivables, payable balances, disclosure, all these things are there, but we did not address your question in detail. It's not like written in the way I'm speaking. Now, coming to the third part, the treatment that is actually happening, unfortunately, I know from a person who is involved in the audit of an insurance company in Pakistan, that right now it has become a nightmare for all the auditors. Because of that reconciliation, the audits even are getting delayed, because those reconciliations could, from day one, this thing should have been managed in a very clear, distinguished way, that what it is to other parties, and the recognition of receivables and payables should have been done the same way. So this is my personal submission, that I think that the real solution is only from day one, anything received on behalf of others is not a revenue as per IFRS, as per AAOIFI framework. Simply speaking, receivable payable accounting, and obviously it has to be done in a more proper way to avoid the reconciliation issues. In a nutshell, we have required for receivables and payables, and we make a note of your point because it's a very important issue. We make a note of that point, and we'll keep it like, like in the guidance or FAQs, as like, we can do to help the question. But receivable, payable, and its requirements are there, and the core principle is still there, that co-insurance or co-Takaful doesn't become your, and if Sharia standard and Pakistan Takaful regulation don't allow you to be the lead for conventional insurance.
We have used the word counterparties here. So you have income, expenses, receivables, and payables, counterparties.
I think we need to clarify. I think it was discussed. I can recall very well that it was discussed and it was partially addressed, but again, we need to clarify more. Thank you very much.
Okay. Second, I'm sure you have mentioned that, and I have heard that, but like this wakala fee, currently what we are doing that we write the contribution and charge a certain portion, whatever we decide, the management decide that this will be the wakala fee charge, and bring it that amount to the operators portion, the revenue portion for the operators, like a management fee. And mostly we apply the same, like, the contribution don't get earned on the first day. We go with the process, whether the 365 days method or 1/24 days method, and that contribution in a method defined by the law. Same thing we follow for the wakala fee, earning of the wakala fee. Like, we don't record the wakala fee as it is as income on the very first day. We follow the same methodology. Like, if we are using the 365 days method, same apply to the wakala fee as well. If we are using the 1/24 method, then so how what I have seen that correct me if I'm wrong, that we have to break the wakala fee in certain portions. Like, we have to identify that this is the acquisition cost portion which we are receiving. This is the direct, like it can go direct, something like that. So if you can explain further for the audience, that would be much easier.
Actually, what the question that you have asked, I remember when I was in Pakistan with EY, we wrote a maybe 12-page opinion on that because there was no guidance available. So for a Takaful company, we wrote a 12-page opinion actually. And then in ICAP Insurance Committee also we discussed, and it was generally agreed by the committee members. So when we wrote this standard here at AAOIFI, actually the main principle was coming from that opinion, which was discussed in the Insurance Committee earlier as well. In the nutshell, brother, the question is like, the question that you have is like, at two different angles. One angle is we are doing the insurance business and it is one portion and that is the other portion, and this portion needs to be recognized over a period of time. This approach has the main connotation that we are doing the insurance business. We are in insurance business. So although we divided the revenue in two parts, one going to PTF and one going to the shareholders, still we apply the same approach of division of them. The second approach is that these are two different businesses. First business is underwriting business and the second business is management business. Underwriting business is forget about AOFI standard. So let's come to IFRS. So PTF business is subject to IFRS 17, which gives the accounting treatment of how to recognize the revenues over a period of time by recording liability and then amortizing and all that. The second method on which we can have a simplified method as well, which results in same 365 days type approach. And the second one is a management business, even under IFRS. So even under IFRS, if you apply IFRS 15 on revenues, what happens? You say that revenue is recognized on the matching principle, and then we have a 5-step model, recognition of all these things. One of the most important element is performance obligation. So what is your performance obligation against the money that you earned? Now, if I earned this money on a management business approach, then what was my performance obligation? So the approach that has been written in FAS 43 right now is similar to the performance obligation approach. So we say we have two performance obligations. The one is the performance that we did already. So again, this can be divided into 3 different types, but point is simple. Some performance is done. Contractual responsibility done. I can recognize that revenue. The second part is I still have a continuing responsibility towards this performance. So I can apply this over a period of times, considering the underwriting management related and bookkeeping and claim management and these things. The third part is a provision part, that there can still be a refund element because of mishandling or because of mis-selling or because of the policy that customer can actually terminate the policy at a given point of time, and then he gets a partial refund according to whatever formula. So we took the performance obligation based approach. But if I recall correctly, again, these are very detailed standards. Give me just a second. Let me just check. I think we allowed if the amounts are not that material on this one, we allowed the other method also if the impacts are not that much material. I'm just recalling because there was discussion. I'm just checking what was the final wording in the standard, because some of these things have gone in long details in the discussion file. No, this was not allowed. This was not allowed. Eventually, it was not allowed. So, nutshell treatment is in line with what we call IFRS 15. It is in line with IFRS 15 based on performance obligation.
So, like you earn the amount right away, like at the inception, whatever wakala fee you have charged.
Exactly.
It's not the same earning process you have to follow, which you are applying for the.
Yeah, exactly. Because that was underwriting business and that is management business. Both have different performance obligation and different revenue recognition methods.
And you said you just inform us that in case of refund, wakala fee will not be refunded because.
No, what we said is that according to the formula, contractual arrangement, you can have a refund or you cannot have a refund. If the formula has a refund option, then you need to make an estimate as to how much need to be refunded on an average basis. So you need to keep a provision for that. So for example, there is an average 2% of total contribution refund. I'm just giving you an example. So your past rents tell you that you have up to 2% of the refunds of the total contributions. So what we are suggesting that you keep a provision up to the extent of 2% to even within the wakala fee if the contract requires the wakala fee to be refunded. There is one situation where some Takaful operators and their Sharia board do not have this mechanism of refund. So in some cases, wakala fee is not refunded. I know that this is in past at least it was there in some of the contracts. So then they added to the contract that a refund of wakala can also be there.
Okay, so, Umar Sahib, I have a question. Omar Saab, I have a question. Basically, IFRS 17 has cater for some of the requirement of IFRS 9. So, what you are proposing in FS 42 and 43 for this IFRS 9 requirement to cater these requirements?
It's a very important question, actually, and this is one of the question where I remember in the insurance committee and SECP there was a challenge, because AOFI, where there is no Sharia issue, we refer to generally accepted accounting principles, which means mainly IFRS, but in different countries they can be local standards. But with regard to IFRS 9, we have our own equivalent standards. IFRS 9, we have divided into 3 different parts. So one part of IFRS 19 is related to derivative and hedge accounting, for which we have a standard on VAT, Khiyar, and Tahawut. One part of IFRS 9 is related to recognition and measurement. So recognition and measurement of financing products we have covered in different standards, but recognition of measurement of what applies to you is recognition and measurement of sukuk, shares, and similar instruments. So your investments are mainly falling in that category. That is our FAS 33. We have created reference to FAS 33 and impairment standard and to general disclosures in FAS 1. These are some of the questions that were discussed, asked in the insurance committee and in the SECP, that even if 42 and 43 are applied, what will happen to those standards which are cross-referred by 42 and 43? The answer to that is in the hand of the regulator to decide. So if a SECP decides to adopt it, then SECP will have to mention in the adoption statement, when they issue the circular, they will have to mention whether the cross-references go to AOFI's cross-references. In that situation, it will be considered that it is part and parcel of the standard. Or if they decide that, no, we want to create cross-reference to IFRS 9. Now, what is the difference between IFRS 9 accounting for sukuk, shares, and similar instruments versus FAS 33 accounting? First issue is effective interest rate method. IFRS 9 goes with effective interest rate method, which goes only with cash flow. Our standard goes with effective rate of return method, which has 2 differences from effective interest rate method. Number one, the timing of recognition, which cannot be before the actual transaction taking place. And the second is with regard to some of the combination of contract, like service fee, being combined with the financing fee. Under IFRS, you have a single cash flow, based on that, you need to identify the effective method. In case of AOFI, some of the fee-based services are to be recognized separately as well. Unless if they are part of the main arrangement, they can be part of the main effective rate of return method. This is one difference that may come in that. Number one. Number two, there are different type of instruments. So AOFI has some conditions that some of the type of instrument may not be subject to similar options available in IFRS 9. So we have options similar to IFRS 9, but if the instrument is a liability instrument, means predominantly liability instrument, then we do not allow it to be having a fair valuation, because a predominant liability instrument means that it is a receivable or payable is there. So Sharia does not allow discounting of that. So only the amortized profit approach on that can be used. So amortized cost approach or amortized profit approach can be used only. This is one example. There can be some minor other options also that we have with regard to different type of instruments, because sukuk instruments and these instruments may have different nature, like having a musharka, mudarbas, ijara at the back end. So these issues are addressed in our FAS 33, and for sure IFRS has considered all the financial instruments to be similar, irrespective of their back end assets, etc. So this is something which creates a difference. Again, when we recommend to SECP and ICAP to adopt AOFI standards, we do not recommend them to go pick and choose that, oh, we want to adopt only one or two. Obviously, as AOFI, we are developing standards in all the areas as an integrated set. But yes, the issue of IFRS 9 will remain there, and it has to be decided by SECP at the time of making the adoption, if they decide, and we hope that they decide, that whether they want to create reference to IFRS 9 or they want to keep the references of the AOIFI standard. Now, just let me tell you one thing, which is the legal position. The legal position is that, for example, there is a new law that creates a reference to an old law. For example, for a definition. What happens that even if the old law is repealed, unless these references are changed for the legal purposes, that definition still exists. These are normally, for that it is better that when better drafters of law always say that these are safe clauses. The same thing applies that, for example, you adopt IFRS, which creates a reference to another IFRS which is not adopted. What happens? Actually, you have a clarification needed to be needed from the regulator itself, whether they consciously, if they keep quiet, then it means those cross references work. But if they specifically clarify that those references don't work, then obviously references are to be created to other places. The question you asked is very complicated. What I have said is something to be decided finally by SECP at the time of doing that. But if you ask me as an ICAP member, as a member of the committee, and also on behalf of AOIFI, I will say pick and choose is not the right solution. You need to take the whole package, which means that even if you don't adopt those standards separately, still those references shall work. Shall we move? I think time is already okay.
I have a suggestion also. Omar sir.
Please.
Basically, you have given a very, knowledgeable presentation. But my suggestion is that IFRS 17 has given a lot of illustrative examples. So there should be illustrative example too, so that the thing you are explaining or presenting can easily be understandable.
Thank you very much. No disagreement on this point. Only two approaches were taken by the board. First, the board decided that we need to come up with the standard immediately so that at least the principal guidance is available, because the different regulators in the countries were already adopting AOIFI standards and they had to adopt IFRS also. So they wanted IFRS 17 equivalent AOIFI standards to be available immediately. So that was the first thing that we did. Now, there are two things. Number one, we need to bring guidelines, including illustrative examples, as maximum as possible. No disagreement on this part. It is in our agenda, but not as priority as we develop this standard. Inshallah, in due course, we'll come up with that, and it is noted. With regard to what happens today, AOIFI has a clear statement in the framework and in the standards that wherever AOIFI remains silent, IFRS and other generally accepted accounting principles apply. So if the illustrative example is not is just about the computation part and other areas which do not have a Sharia issue, they apply as it is. And the other examples where the impact is there, we need to come up with that. We don't have we don't have a disagreement, and we need to come up with that. But with regard to the general computation related examples where there is no difference in principle with regard to the accounting, still those illustrative examples given by IFRS apply. This is the present statement. But yes, fully agreed, we need to come up with guidelines, including the illustrative examples, and inshallah we'll try to do as soon as possible.
We have some question in the chat.
Okay, now I can see three questions.
Can I ask a question?
Please, brother Kamran, please go ahead.
Sir, I have two questions. One is regarding onerous contract. As per IFRS 17, we need to determine onerous contract at the time of booking of policy on group basis. And once it's determined, we need to apply GMM model or set aside a separate provision for onerous contracts. So how do we treat onerous contracts in FAS 42 and 43? And second is, as far as IFRS 17 is concerned regarding risk adjustment of claim side, we need to provide a provision on risk adjustment in all claims, whether 1 year or more or not. So how do we treat risk adjustment in a claims side in FAS 42 and 43? We have a provision in both of them in these contract, standards?
Kamal sir, good question. Nutshell answer is treatment is more or less exactly the same as IFRS because it's not a Sharia issue. So the treatment that is defined in the standard is more or less exactly the similar. Now, what is the difference? Difference is what constitutes the fulfillment cash flows. So for example, in case of Takaful, you say that I have a 35% wakala fee. So what happens that immediately as soon as you get the revenue of 100, you have a cost of 35. You might have more onerous contracts or onerous arrangements as compared to conventional because of this 35%. You got my point? So there is quite possibility that while the core treatment is similar, but because of having 35%, 40%, even more than that wakala fee in some of the companies, immediately the whole portfolio goes into loss situation. This is quite possible. And here comes the other question, which is not an accounting question, but a governance and Sharia question, that what is the right amount of wakala fee? Is it justified to charge very heavy wakala fee while these contracts go to onerous in beginning? So we have put a challenge question there that if it is the situation, then Sharia board has to check if it is for example, I appoint you as an agent and I say, brother, go and purchase for me a mobile phone. I gave you 5,000 rupees and you went and purchased immediately something of 10,000. You put me on a loss in day one. You got my point. Now I don't have money. After putting, just to complete. So after putting the wakala fee and re-takaful contribution, I become in loss situation immediately, which means that you might be negligent as an agent. You are not doing service to your customer, rather you are making a harm to the customer. So here the Sharia board will have to, again, it's an accounting standard. So we did not say that it is not allowed to do that. But from the question comes in whether you are a negligent agent. If you are a negligent agent, then it becomes a receivable from you as a Takaful operator because you did something harmful for the principal. In a nutshell, the risk of having onerous arrangements for Takaful based on the market practices that we have seen is much higher because of higher wakala fee.
Sir, it means as far as medical portfolio is concerned, it will be a loss in initial because in all cases of medical, it is considered at 80 to 85% considered to be a very good loss ratio. If you set aside a 25 minimum or 20% in fact, so it means the medical portfolio goes into losses or will consider to be a onerous in ab initio.
I fully agree. And that is where the Sharia board and the board of directors need to kick in. They need to see what is the right amount of wakala fee for medical business. Because even after doing this and paying the re-takaful contribution, what you are left in the institution. But within the PTF, we are afraid that current market practices will result in lots of onerous arrangements at the beginning.
What's up? I have a question. Please. Basically, IFRS 17, split how it goes into the attributable and non-attributable costs. So there's a solution if we consider commission in Takaful as attributable cost or other attributable cost as the part of the participatory Takaful fund. So this issue will be resolved automatically. I mean, we should have to charge a low wakala fee as compared to charging high wakala fee if we consider commission and other acquisition costs as attributable expenses.
I fully agree, and actually we also said the same thing, that it can be part of the acquisition cash flow or acquisition cost depending on the contract. So it will depend on the contract and regulatory requirements. So as per contract and regulatory requirements, how it is put in, based on that, it will be part of either acquisition cost cash flows, which goes to PTF, or acquisition cost, which goes to the shareholders. But your point is completely valid, no disagreement. And we also have more or less same treatment with option, like depending on the contractual arrangement. Now we have two questions on the on the chat window. So first is from Sidra Kanwar, and are we going to implement whole Islamic accounting standards to different assets and liability valuation? I think I answered part of your question. It will not apply to all, but the question will be whether IFRS 9 or is suitable for that or not. This will depend on an overall basis. I would say that it will be more dependent on SECP's overall policy for adoption of AAOIFI standards, not only for Takaful, but for all Islamic finance. So if the SECP decides to adopt other standards also, it will happen. With regard to Ijara, already you have IFAS 2 applicable. Normally, Takaful industry does not have any Murabha arrangements. So FAS 1, IFAS 1 does not apply. But local, Pakistan's Islamic Financial Accounting Standard 1 and 2 still apply to you. Although you don't have IFRS 1 related transactions, but you have IFRS 2 related transactions. So it means on the liability side, you have Ijara at times. So this is something that is like, still be there. It will be dependent on the overall policy of SECP to adopt AAOIFI standards. Obviously, we are recommending to them that they should adopt. Second question is, how about NAV valuation? Would be worked out if assets are not valued at fair value? It's a very good question, very highly appreciated. The point is that according to Sharia, you can have almost everything at fair value, except for one thing: establish receivable or payable. So if you need to pay me 100, and I say that I want to sell it to somebody else for 105, it will be riba, it will be interest, so it cannot happen. But yes, if I have a receivable from you for against which there was a profit, and that profit can be amortized, so the amortized profit can still be there. That amortized cost accounting can still be there. So that actually reflects as close as possible to fair value normally, not exactly all the time, but because the market interest rate versus the interest rate intrinsic in the transaction might be different. So considering these differentiating factors, there can be slight differences. But the rule is established receivables and payables are not fair valued because their fair valuation may result in a Sharia issue because it is equivalent to riba. Normally, still, your investments will be in, number one, sukuk. Number two, shares. Number three, mutual fund units. For all these things, there is no issue of fair valuation mostly. Only issue comes if you have commodity murabha transactions or other similar transactions based creating a receivable. That will be the problem, because at times for capital protection or something, you do some commodity murabha transactions also, although it's not that much common in Pakistan, but more common outside. So that is the place where you will have problem. For other type of transactions, normally fair valuation will not be an issue, and you can always have the NAV. Now, the point is that I think we have covered the time. I could not cover some of the key differences, although the differences that we are going to discuss going forward in the presentation were actually, I think most of them are covered already, and we will be sharing the presentation with all of you. As the time is already over, I would touch only one aspect with your permission. Only I'll try to take 1 minute before I conclude at my end and before the SECP director concludes. The point that I have is only one point which creates a fundamental difference, that is the control issue. The control issue is that what is controlled should be on balance sheet, and what is not controlled should be off balance sheet. This applies to the individual transactions and individual balances, and it applies to consolidation. The argument that we have is that control requires, according to IFRS, the control requires that you should have, number one, the governing rights and power. Number two, variable returns. And the variable returns, the power should be able to change your variable returns. Now, the first thing in Takaful industry, the power that shareholders have over the PTF is in fiduciary capacity, not in your own capacity. Number two, it does not result in variable returns, because variable returns means losses also. As per Sharia, you can, you can have in Mudarba and Wakala, you cannot have losses. So it means that losses, which is part of the variable returns, is not there. So it is for fiduciary capacity, and it is not for, you are not exposed to losses. It means you don't control it. Now, what I want to conclude out of this, because it's a long debate, it's just a nutshell summary I would like to mention. The summary is the Takaful operator does not control the PTF and PIF. It cannot put the assets of PIF and PTF in its own books. Naveed sir, I think I answered your question partially here, that the control issue actually impacts that. But that impacts on two other levels as well. So first level is operator does not consolidate and put PTF and PIF assets in its own books. The second issue comes if there is a conventional company having the Takaful window, can that conventional company add the contributions and premiums together? The answer is you don't control it. And the revenues obtained on behalf of others are not to be added to your revenue. These are the general accounting principles. Everything what I'm speaking is similar in IFRS and AOIFI. So the question is, if the PTF is actually entitled to these gains and losses and everything, then you do not control it. So even when you consolidate the parent's accounts, you cannot do it. So we have, as of now, in Pakistan, the Takaful regulation, accounting regulations for general are very clear that separate accounts are to be attached. Family is not following it, but separate accounts of the window are to be attached. That is part two. So the first part is the Takaful operator not to consolidate and put in books PTF and PIF. Second part, conventional company not to put Islamic window in this. Net receivables and payable position will appear, net profits and losses will appear, but not to be adding line by line. Third thing, parent being conventional and subsidiary being Islamic is still when you can consolidate, you don't add up the revenues. You bring it the net profits coming from those operations. So this is one of the most important elements, I think, with regard to the overall presentation, which again, as I mentioned, it's a very long subject. It needs quite a long time. With that, I would like to thank you all for your patience and apologies for taking a few more minutes. I think we started a few minutes later as well. So with that, at least at my end, I conclude and we leave to the floor back to ICAP and SECP. Thank you very much again for giving me this opportunity to be here. And thanks, Brother Harun, for being with me. Assalamu alaikum.
Assalamu alaikum.
Walaikum salam. We can hear you.
Thank you, Omar Saab, for such a detailed session. And session is particularly well attended by the IAP members. So more than 60 people were present in the session, and you have provided a detailed overview of the whole session. The objective of today's session was that, as discussed in the last TWG meeting, that on the request of IAP, that they need some session on the implementation of FAS 43 and FAS 42, or we will go for IFRS 17. And there are the two main option was discussed in the last TWG meeting, that either we go for full implementation of FAS 42 and FAS 43, or we go with IFRS 17 and parallelly some accounting regulation and disclosure requirement in light of FAS 42 and FAS 43. So now I expect from the IAP that in the next TWG meeting, we should have some feedback from the IAP regarding these two approaches, so we can conclude this matter in our next TWG meeting. So I expect Naveed Saab and the other members that in the next TWG meeting, we will discuss to finalize the option as early we discussed in TWG regarding fully adoption of FAS 42 or FAS 43, or we go with some Takaful regulations in light of the FAS 42 and FAS 43 with implementation of IFRS 17 on PTF level.
Yes, Wasim Saab, you rightly mentioned that. So now we have listened what the standard is and how it's gonna work. So IAP will do the analysis, further analysis and internal discussion. that what option, as you mentioned, there are two options in discussion, one which Umar Saab just presented, and the second option is that go with the IFRS with combination of IFRS 15. So we'll discuss that internally and we'll provide our feedback in the working group.
Okay, thank you. Umar Saab, once again, thank you for this brief session, sir.
Thank you, sir. Thank you again, everybody. Thank you. Assalamu alaikum.
Thank you, Ji. Thank you, Umar Saab. Allah Hafiz.
Thank you, Naveed Saab. Assalamu alaikum.